Hi, folks. As you know, equity markets in India are booming at this time, but something unprecedented has happened. Gold has also surged up. Normally, when equity markets are up, gold goes down, but both these asset classes are up. So I thought it would be the right time to look at gold returns and see how they compare against equity returns, as well as whether it could be a good instrument to invest in. So the first question that came to my mind is where can I get authentic gold data? Because everybody talks about the past when gold was cheap. During our wedding, the prices of gold was so much, or when we bought for our daughter at this time, or for our son at that time, the price was so less. So I found that RBI actually has a bulletin which they publish every month, and in that they record the prices of gold for they mention 10 grams gold. So you can see the price here. They've given it both for the month of Feb and for the month of Jan. This was published in April. And they've also given last year's price as well. So this was an authentic source of gold prices that I could take. So then what I did is that I took the prices in the month of Feb for all the last 25, almost 25 years. So from 2000 onwards, I put the prices down. The next step was to calculate annualized returns for the periods of 1 year, then 3 years, 5 years, 10 years, and 15 years. A quick refresher on annualized returns. If you invest in something today for 100 rupees and the price goes to 120 rupees in 3 years' time, that means you made 20 rupees as your capital gain, which translates to 20% return. But that 20% is absolute return on your initial capital invested. But your 100 has moved to 120 rupees over 3 years. So every year you got 6.27%. That is your annualized return. And only when we have annualized return can we compare against any other asset class, be it fixed deposits or property, gold, stocks, crypto. Any asset class you can compare once you have the annualized rate of return. Now, two things which you have to look at here is that I have given trailing returns, that is point to point returns. I've taken one point in time and compared it with another point in time. It's always better to have rolling returns and make a return distribution table to see the number of times you fall in different percentages. But I didn't have the data for it, or the timeline is quite vast, so I could not calculate it. The second is that there are no expense ratios or expenses associated with these prices. Again, for example, if you are buying physical gold, you might put it in a locker and there's an expense related to that. Or if it's a gold ETF or a gold index, gold fund, then you'll be paying an expense ratio. That also has not been factored here. Now, in this table, you can see that I've calculated the 1 year return. Now, I've made two assumptions here. One I've assumed is that an equity mutual fund will deliver 12% or higher, and this is a good return from an equity mutual fund. The second is that if you were to invest in an FD, it's very easy. At the click of a button, you can move funds and start an FD. But you're taking the trouble to go find a gold fund or invest in gold, and therefore you're taking some more trouble. So you should get something higher than the current rate of FD. So I've taken 9%. So if you were to compare against an FD, you should get 9% or more. If you're comparing against an equity mutual fund, you should get 12% or more. Also, people in India always say that the price of gold are steady, they don't drop, they'll always increase in value. It's a safe place to invest in. So, does it give negative returns? These are three aspects which I wanted to compare on. Now, if you see here, I've calculated the 1 year returns for the period from 2000 till 2024, and I've highlighted the last 10 years in the red block, where I thought that would be more relevant for us today. Now, when I look at the number of times it has returned negative in the last 10 years, it has happened only once. But at least we know that yes, gold does return negative sometimes. It's not often, but there is a chance that our money could be negative in a 1 year time period. And when I compare against a return of 12% or more, which is what my assumption is that an equity mutual fund will deliver, four times only it has crossed 12% or more. Those are the parts which are marked in green. And when I compare with 9% so that it exceeds an FD return, this has happened 5 times out of 10 times. So this is how the 1 year return stacks up of gold against these assets. Now, if I look at a 3 year annualized return and I take the data for the last 10 years, then you'll see that 3 times gold has delivered negative returns. And against a comparison of 12%, it has delivered 3 times out of 10 times. And again, against the 9% return, which is comparable to the FD, it has delivered 5 times out of 10 times. The 5 year returns is marginally better because it does not give any negative returns in the last 5 years. It has also beaten fixed deposits, as in the expected returns of 9%, 6 times. But the comparison against 12% still remains poor, only 3 times out of 10 times this has happened. If I go to the 10-year period, then you can see that again there's no negative returns which has been delivered here, but the number of times it delivers 12% is dropped. It's gone to 2 times, and against a 9% rate, it has moved to 6 times. And against the 15-year period, it stacks quite well. No negative returns. Against a 12% expected return, it has delivered 6 out of 10 times. And against the fixed deposit comparison of 9% or so, it has delivered this 10 times. So this is the best return of the lot. Now, I just wanted to show you the whole grid here so that you get an overall picture. And if you look at it, you'll see lots of green fields in the earlier years, but in the next or in the latter years, it is mostly red. Why has this happened? Because in the period between 2012 and 2019, which is highlighted here, the price of gold has barely moved up, and in many cases, it has moved down as well. Right? So this is what has caused the returns in the latter years to, or in the years closest to us, to come down. So we also need to look at the short-term returns to compare with FD. So I've compared in the 1 year and the 3 year returns category. So you can see that there are many times that it beats FD returns here, but it is not dependable like FDs, right? Because in fixed deposits, you know that your money is only going to be positive, but in gold, it has delivered negative or less than FD returns, which is not something which is desirable in the short term when you park money for the short term. So to summarize, I would say that gold is a good diversification tool. It is a good hedge against uncertainties. So these are two factors which play in favor of gold as an asset class. But return expectations should be tempered. We've seen that gold does give negative returns. There are periods where it does not perform very well even against FD. So returns should be tempered. And so when we get a higher return, then we'd be more happy with that. It's also important to remember 2 points. One is that gold does not have any intrinsic value. Like when you purchase shares of a company, or when you know that there's an underlying company trying to generate some sort of value, keep income coming in, keep expenses down, and therefore generate a higher profit. But gold is driven by demand and supply. So there's no intrinsic value for the asset. We also need to remember that long-term demand for gold may come down as younger people may not have as much fascination or liking for this asset class as the current generations. So I hope this helps clarify any doubts that you had about gold as an asset class, whether you're leaning towards gold or against gold. As always, I would say that diversification is a good tool. One should look carefully at the risks associated with that asset class, with the returns associated with that asset class, and then see if it is suitable for us to invest in. If you have any queries or comments, do drop it or reach out to us on our contact points, and we'll be happy to get back to you. Thanks for watching.